Hi, my name's Brett Marsh. I'm CEO of the Pentafin OneVue Managed Accounts business. Now I want to go through why SMAs are so much better than their managed funds counterparts as an investment vehicle of choice. The first one is tax efficiency. And we've walked through some of this before, and I'll give a little example at the moment which will illustrate in this market the sorts of conversations an advisor might have with their clients depending on whether they're in a managed fund or in a managed account. It is actually really important we can throw often as a tagline that there are no inherited capital gains. And what does that really mean for a client? It means that a client might be investing for every $100 that they put in, $70 might be going into a capital gains cost base within a managed fund, and maybe $30 of that is going into an unrealised gain, which is just waiting for a transaction before it becomes part of a distribution. The second is intelligent tax lot selection. So when a client or an investor sells an individual security, the technology within many managed account providers at the moment actually has the skill to go and choose the best tax lot for that client. It's something which is customisable for dealers or advisors to choose the best way that they want to select their tax lots upon a sale, and it can also work across mandates. So the sorts of things that can occur here is, choose a capital loss first, choose a discounted capital gain after that, choose the smallest discounted capital gain, and defer the tax as much as is possible. Corporate actions is also efficient. Now I've put this here, this could be under operational efficiency, it could also be under tax efficiency, but if you have a pool of investors and there's a big buyback with a franked dividend component to it, you can make the most out of that franked dividend for your clients by segmenting the clients within the total amount of the portfolios between who can benefit for those tax credits and who are not going to benefit. The second grouping of differentiator between managed accounts versus managed funds is in the trade efficiency. Now, the grossing, I guess, is not something which is different, but it's worth going through a little bit. Grossing is important to small investors, and this is something which is like the pooled concept which comes out of unit trusts. If you've got a whole bunch of investors putting in $10,000 and they're going into a portfolio where there's 30 stocks, it's pretty hard to go and execute 30 individual little trades there and get efficiency out of your broking. Now, when you pool those together, which happens within a managed fund, then you basically if you have, say, 10 of those clients, then now you've got 100,000 to spread across your 30-odd stocks, and you can get some trade efficiency. Managed accounts work in exactly the same way, because under a single structure, you can put one trade through on behalf of many investors, but the many investors still retain their individual beneficial ownership. You also get a netting which goes on. So there'll be some clients who are buying and some clients who are selling. So that happens every day on a wrap or a master trust, and the investors are all picking up the buy-sell spread every time that happens. Whereas in a managed account, when you net trades, there's no brokerage that is charged to the client. So that is intrinsically more cost-effective for the client. As I mentioned before, the corporate actions also come under the trade efficiency in many managed account providers. Depending on the business model that you choose, that corporate actions can be centralised. It's also potentially customisable that in a more personalised, individually managed account structure that actually may not be centralised. But it can be centralised, which is an important point because that becomes a deterrent for some advisors under other direct share structures. It's customisable. You are in control. The dealer groups are in control. The advisors are in control, and the investors are in control. You get to choose that if you see a particular stock or security on the market that you don't want to be part of. It may be a stock in the current environment which you think is highly risky, and so therefore you want to lock that out of your portfolio. It could also be because of ethical reasons that you choose not to own particular stocks. And the final one is transparency. You get to see what you really own. From a customer, this is enormous. How much am I exposed to Centro? How much am I exposed to Orco? How much am I exposed to some of these what are perceived to be very high risk and falling price assets which are out there today? You don't get to see that within a managed fund structure, but within a managed account, the advisor and the client and the dealer all get to see exactly what the client beneficially owns.